Okay, welcome everyone to the next session, which is a talk and discussion on monetary sovereignty, addressing the challenges of digitalized and multipolar world. And we're having Professor Ulrich Bindseil doing this presentation. As some of us heard, he's not he's not still with the European Central Bank, but he used to be there for quite a long time as in the market of infrastructure and payment systems. His teaching is centered in central banking and financial stability, payments and market infrastructure as well. Recent work was tiered CBDC and the financial system. And the other one, the previous one is from 2020, and another one is central banking before the 1800s, rehabilitation. This one is from 2019. So after Ulrich's presentation, we will have Larissa. I think she's here, and after her, Jay will be discussing his presentation. Okay, Professor Ulrich, the floor is yours. You can start.
Thank you, Marina. Let me share my screen, and some of you, it's great to see you all again, and some of you have heard variants of this presentation before. That's why I will be very disciplined in the time I use, and the discussion will really be key. So now let me share the screen, and no, that's not, I want to share this one, and then start the slideshow. Continue to share. I hope you can see it. So monetary sovereignty, and this talk is based on work with Richard Senner, who's now at the Financial Stability Board. And we have 3 papers out there. This is a book project. It should be a book one day. And we have produced already lots of pages. And this presentation today is based on the 2 first papers, Revisiting National Economic and Monetary Sovereignty, which are really the first chapters of the book. And then the next one is really all the policy topics that we face. So yeah, let me start by saying, I think monetary sovereignty, everybody feels that it's currently under threat, but it was never, it was never not under threat. It was always a topic. I think if you go back to 1800 or 1300 or 1900 or 20, the turn of the century, whatever, I think it was always a feeling that it is endangered. So there are here 2 books, by finance / economists, one from 71, one from 92, who both claim that sovereignty and financial monetary sovereignty are at risk. So just a rush through a few current, themes. One theme is the loss of relevance of central bank money in retail payment. Here, this is a table for the euro area. The way, the use of cash is crashing. We moved to online shopping anyway, where central bank money is not usable. But even at the point of sale, you can see within 8 years, the share of cash went down from 54 to 39. And the euro area is not really amongst the most advanced on average in this field. And Madame Lagarde, the ECB president, mentions that as being a matter of strategic autonomy for the euro area. And also others have written books on this and claim that this is, a big topic for sovereignty internationally as well. And then another example, in retail payments in Europe, the US international card schemes are very dominant, but not only in Europe, also in Brazil, and they were, but they are a bit less now because of Brazil introducing an instant payment-based solution called PIX, and that irritated the US people, the current US government, which claimed that it's a matter of unfair practices with respect to electronic retail payment. Silva pushed back. PIX is Brazil, and it's a patrimony of our people, although it's only 5 years old. And then, of course, one cannot, overlook the crypto crowd on this respect. So, they constantly place their point in social media why Bitcoin is the solution to everything. And they just want, of course, that the bonanza doesn't stop, that prices go up, so that those who hold Bitcoin today become richer and richer. But they have to claim that it is something useful. And here they say, this guy says it's about financial sovereignty because the central banks rip you off. The government rips you off, yeah. So, And then, of course, the stablecoin topic, the US, very ambitious in seeing a dollarization, relaunched with stablecoins, with new technology. Also because the US has an issue with high debt levels, increasing debt levels, a huge negative net international investment position. And this is, of course, a kind of ticking bomb, in particular if you take aggressive policies towards the rest of the world, which are not so good for the trust of the rest of the world into you. So you may need new sources of capital inflows when you have all those outflows. And stable coins would be something for that. But some have called that a matter of crypto mercantilism, because dollarization, of course, means grabbing a part of the seigniorage income and reducing the relevance of domestic sovereign currencies. And sovereignty has existed as a topic for a long time, and I will skip this. States have existed for a long time. The term sovereignty comes from the 16th century, is associated with a guy called Jean Baudin. And then, of course, other authors, philosophers have taken that up. Hobbes, Locke, they all frequently refer to sovereignty. And then Jean-Jacques Rousseau introduces popular sovereignty, which links sovereignty with the people as ultimate sovereign, then some people say he has had two, let's say, socialist ambitions, or talking about the general will, which of course doesn't really exist. But he also, I think that's what this quotation suggests, kept the spirit of Locke in terms of preservation of individual freedom, at least according to this quotation. He was saying, nevertheless, everyone should obey only to himself and remain as free as before, despite, let's say, this community that is established for many good reasons. Let's move now to today's discussions on what sovereignty is, and maybe the guru of sovereignty is someone called Krasner, more a political scientist, and he has defined sovereignty from 4 perspectives: international legal sovereignty, Westphalian sovereignty, domestic sovereignty, interdependent sovereignty. My problem with all those definitions is that they overlap. They're not so well structured. They are all relevant, but they are not, let's say, distinct from each other. And also the democratic impairment of democratic processes. So what Rousseau may have had in mind also, or popular sovereignty has in mind, is not really emphasized here. So that slide makes a point that Krasner's concepts are a bit messy. This international legal sovereignty is maybe a separate concept, but the way he defines domestic sovereignty and interdependence and Westphalian sovereignty is messy, I thought. And then another one, the standard legal definition of lawyers of monetary sovereignty is something like this. Monetary sovereignty is the state's ability to exercise the right. Then comes a list of things: issue money, determine the unit of account, regulate the use of money, determine the legal tender, conduct monetary policy, and so on. So it's a list. Yeah, that's fine. That makes sense. But it is, okay, it's not very conceptual, of course. And the problem is, again, it lacks the emphasis on popular sovereignty in a time where there are many governments who don't do necessarily what is in the interest of the people. This should be a topic, no? So this is just, the ability of the state to do all that. But shouldn't we, if we want to emphasize popular sovereignty, ask the question, is what the state is doing also in the interest of the people? That's illustrated here. I mean, it should not be like here, that citizens are just one amongst many stakeholders, that there are citizens, banks, non-bank financials, non-financial firms, foreign states, that they all lobby the government and want to get something from it and get something. It should be like this, no? Citizens are the subject and object of sovereignty, and the others are all, then objects of the sovereignty, in the sense that the legislation and the other measures of the government aim at those other parties in the interest of citizens only. So here's, let's say, the way we try to order things: monetary sovereignty, subset of economic sovereignty, subset of state sovereignty. We emphasize the people, not the state per se, and we want a definition where domestic and international monetary sovereignty are complementary, that monetary sovereignty is the union of those two. And here is the definition which would do this trick. Monetary sovereignty of a nation is the freedom and ability of its people to effectively govern themselves and to decide and implement the best policies in their present and future interests regarding the creation and the usage of currency, unit of account, means of payment, store of value function. And then we define a nation achieves domestic monetary sovereignty if monetary sovereignty is not impaired for reasons originating within its state territory, and international for reasons outside its state territory. And in this way, the two are just complementary, exactly, because everything needs to originate either from A or non-A. And that's how this definition is set up. And then, of course, you can, like in the legal definition of monetary sovereignty, you can zoom into various aspects. And this is done here. All those topics, the blue ones are core monetary sovereignty, financial market, infrastructure. This goes a bit beyond money. And then cybersecurity and preventing fraudulent and illicit payments are general issues core to sovereignty, which also are very relevant for money, of course, but they're not exactly monetary sovereignty only. Why does sovereignty matter, monetary sovereignty? For a moment, every aspect of society requires sovereignty, or sovereignty matters if it requires collective decision-making, and money relies on and benefits from a variety of collective choices. Gustav Knapp's theory of money has explained to us already 120 years ago that any efficient modern form of money is inevitably a legal construct. Network effects imply public good characters. I mean, there's almost no other good which so obviously relies on network effects as money. So if you let one player dominate it, a private player, you have market concentration, abuse of market power, and financial power to influence decision-making. Look at the market capitalization of the big payment companies. So this means financial power and ability to influence, and also vulnerability of society to systemic instability and external threats. This is maybe I go quickly. Instruments. Let me go to this slide. So there are some fundamental policy attitudes on monetary sovereignty. There are very different views. So I already mentioned Knapp, state theory of money. Strong state is core. So this is clearly advocating the importance of sovereignty. Using the term sovereign are the sovereign money initiatives, which are basically claiming that we should use CBDC technology to overcome ultimately the instability from private money creation, with advantages from financial stability and fiscal perspective. Central bank money should be the only form of money. So then if we move in the other, side of the spectrum, liberal economists, that is maybe most of us are liberal economists, I don't know, but they would say the coexistence between public and private money is good. It has, allows for comparative advantages of those two players. On one side, we anchor the system in central bank money, and we have network effects because everything is convertible into central bank money, singleness of money, and the private sector has, of course, advantages in terms of agility, processing decentralized information, providing credit on the basis of issued means of payments. That is the kind of moderate view, a bit boring, but probably reasonable. Then we have libertarians, Hayek. Some people told me I should not call Hayek a libertarian. Forgive me, I still do it here. So he's in denial of the need for the state to care about monetary affairs. This would only be counterproductive. So this, I would say, is a denial of the role of monetary sovereignty, except, you say Hayek wants to prevent interest groups to hijack the state to achieve their vested interest via imposing public money. If you turn it that way, you could say also Hayek advocates monetary sovereignty. And then we have what one could call the nationalists. In the past, they were called mercantilists, which is the idea to promote your own it's an international concept, promote your own economic policies, your interests via your policies at the expense of rival economies. And the modern variant of those nationalists, they want to use money and payments to benefit their nation also at the expense of other nations. Sovereignty by those people is equated with the denial of international cooperation. And the opposites are the internationalists who believe into the benefits of cooperation for achieving Pareto improvements. Now, quickly, 10 topics, 10, let's say, current topics of monetary sovereignty. I mentioned the first one, disappearance of central bank money use, the conventional form, cash. So what would be the reaction? The simple one is, issue CBDC. It's almost trivial. It's an absurd idea that the central bank should be the only player to stick with 17th century technology. Nothing against cash. Central banks should continue to issue banknotes, but they should not feel constrained to not also issue digital money. The private sector, the banks, and all the others, they, argue against CBDC, but they have, of course, without hesitating for a second, all moved into electronic payments. None of them continues to issue paper-based means of payment. So there's quite some hypocrisy in claiming that it's an absurd idea that the central bank wants to do that. Then we have this global dimension of large retail payment service providers, the Visa and MasterCards. And those firms do a good job. That's why they are successful. And, the fact that I can travel with my card globally and pay everywhere is fantastic and is the result of enormous investments of those companies. But still, an over-dominance is not good, means potential abuse of market power and strategic vulnerabilities. So what India and Brazil have done to build instant payment-based solution at the POI and for P2P is good and successful. It's complementary to CBDC. One shouldn't exclude the other. Retail payment is a huge market, and electronic retail payment markets are growing and growing. So there's no risk of overpopulation with solutions. Then, the whole blockchain, stablecoin topic, Bitcoin topic, those are my topics 3, 4, and 5. And one thing is, of course, from this perspective of society, restore consistency of KYC and AML CFT across all payment options. So the fact that you leave unhosted wallets for global payments without, controls on public blockchains, I mean, it's an enormous level playing field issue. So if you conclude that's all fine, then you should maybe revise also the huge, regulation of banks on AML CFT and allow them to do whatever they want, because regulation of banks will not be effective if it will be effective, but it will not solve anything if you have a parallel universe for illicit payments. So there has to be a full emphasis on regulators on restoring this level playing field to be effective. On dollarization, I mean, countries should know what they want, and some like India and China have taken strong stances against stable coins, but it's not so easy, of course, because even if you cannot prevent that people, importers no longer repatriate their money on domestic accounts, but that the money ends on public blockchains and is, let's say, disappearing from the controlled world. So there are quite some issues. It's not so easy to prevent dollarization if we have unhosted wallets on public blockchains. And okay, the Bitcoin bubble, I believe it's a bit shrinking, but it should shrink further to reduce ultimate costs to society that it creates. Then economic rise of the global south. I mean, that raises the question of the international role of the dollar. If the renminbi is the biggest trade currency, should it not also become a global reserve currency? One big issue here is the liquid financial markets of the US and the huge negative NIIP position, which allows really for the dollar to be the natural international reserve currency. So imagining the shifts that have to occur to move to a currency of a country which has a net international investment position positive is very interesting and not easy to imagine. And empirically, one cannot see that this movement would have started. Then, general globalization and the deterioration of geopolitical cooperation, that creates a lot of tension. On the one side, you want common system, network effects globally, common standards. At the same time, nations do not want to be exposed to sanctions and want to keep their own systems. So those two, are not really compatible, and one should find best solutions to combine, this desire for autonomy while reaping the benefits of common standards and systems. And then two finally different, somewhat different points, high public debt levels. Let's not close our eyes in view of the fact that Western democracies have unprecedented debt levels and they are growing, and we have aging societies and continuing deficits. And that risks fiscal dominance of monetary policy, of course, distributional conflicts. If sovereign defaults, it means they lose financial sovereignty in the worst way, and monetary sovereignty as well. So that is a ticking bomb also. And in the EU, we have the interesting situation that lender of last resort role of the central bank to states is not really foreseen. So it's not supposed to happen. It's a kind of Odyssean choice that states took when they joined. But some people like Alieta and Orphanides would classify this as a stupid constraint and as an undue restriction of monetary sovereignty. And last but not least, declining democracy. I mean, I wished it was not true, but objectively one can measure that democracy is in decline. And why not extrapolating that into the future? And that, of course, means that if we think about popular sovereignty and the interest of the people, then it's not necessarily getting better. So thank you very much. I stop here.
Thank you, Professor Ulrich. Larissa.
All right. Thank you so much. That was excellent. I've learned so much from your work, and it's an honor to be reacting to it. And I did prepare my remarks more focused on your monetary sovereignty paper, but I'll try to also adapt to what we just saw as a group. So I work for the Oliver Wyman Forum. It's a think tank within a consulting firm. The views I express here are my own. A lot of my work is about communication and translation. What is it that people need to understand from the literature, from cross-sector perspectives to ensure that their goals are met? And I've been in conversations with the public and the private sector on the universe, especially of digital assets, for the last decade, even before the Libra days. So I read the paper under this perspective of how does this definition of sovereignty help shed light on the universe of options, the goals to aspire to, the tools to reach them, and the trade-offs involved. From that perspective, the paper does this amazing job at mapping the terrain of monetary sovereignty. I love the grounding on the populace rather than the state, as it's more expansive. There's a systematic treatment of all these different dimensions that go into monetary sovereignty, and especially the insistence that the capacity to achieve monetary sovereignty exists in shades, not necessarily binaries. So I think all of that helps lay the work in terms of what does this mean in terms of implications for what could be done. And I wanted to flag two areas where I think the framing can be sharpened and then also raise a question. So first, there are in different places of the paper, and I saw this in the presentation, there's expression of like benefits, goals, and tools. And I wonder if a more sharpened focus on potential goals could be useful. So we see this in your list of benefits. There's macrofinancial stability, microeconomic policy objectives, reducing dependencies, and we see this in the dimension between like reducing illicit finance, protecting cybersecurities. Those all seem to me as goals. And then something like seniorage income seems, or information advantages, struck me more as tools instead of ends or goals of monetary sovereignty. Senior income itself can accrue to the public sector or be used to incentivize private coordination. Each of those choices leads to very different outcomes, which may or may not fulfill different goals. So I think that focus on goals versus trade-offs would be quite helpful. And then similarly, as you have this long list of 10 dimensions, and you allude to the fact that these dimensions all come in different shades according to the capacity of the private versus public, the domestic versus international, as well as state capacity. I would actually love to see capacity be made even more central and more clear into the forefront of those dimensions. For example, money issuance is really about the capacity to maintain par, which I think is the very money view perspective. The unit of account then layers on the capacity to achieve adoption and have spread. Means of payments then adds this capacity to coordinate action. PIX is a beautiful example that illustrates strong domestic coordination capacity, then under threat from the international perspective. And Visa and MasterCard illustrate what happens when that capacity is ceded too much to the private sector. And this focus on capacity then allows you to look at the monetary policy dimensions and see that capacity is nested. Maintaining domestic par requires capacity to manage exchange rate shocks. That in itself might require lender of last resort capacity in foreign currencies, as we saw with Credit Suisse. And that requires access to Fed swap lines, which then requires the capacity to maintain healthy geopolitical relationships. So there's these nestings of different capacities, and they will be very clear to the money view reader. Like will read what you say and already understand that in the back of their mind. But for some of the audiences that I speak to, laying that out more explicitly would be very helpful. And then to my final point on like the question that it raises is whether capacity can and will get exercised. And I think that there's a few different challenges here that are hinted at. There's this legibility challenge. The paper says the sovereign should find the optimal balance between rights and obligations, but the information to understand what is optimal doesn't exist. Consider the digital euro. We're years into that project, and there's actually active public disagreement about whether retail or wholesale should have come first. The system is complex enough that it's reasonable for people to disagree. And this is a problem not just for the public sector, but for banks. There's this question around why are they considering stablecoins and not deposit tokens? A lot of it about the uncertainty of regulation, but also more critically, it's about legibility of business cases that would justify the investment. Related to this problem of legibility, there's a bit of a signal asymmetry. Most of the monetary system operates quietly, and that quiet is actually a symbol of its success. For a lot of citizens, the clearest revealed preference is that they value convenience. The move from cash to deposits is a revealed preference. The fact that deposits themselves are so sticky, it means that people value actually not having to think about money, the price of money. They value just having par, having it be accessible. So these capacities are somewhat hidden from the day-to-day discourse. We're trying to build consensus around protecting something that's invisible. And that becomes especially heightened in contrast with these marginal innovations like stablecoins, DeFi. They generate these really loud signals that capture some of the political energy. And there's this matter then of this vacuum dynamic. The sovereign takes time to act because it requires institutional speed. Then the market moves at market speed. And you point to the fact that states can legislate when problems become material, but the problem is when something becomes material, it also means that it has generated material wealth. That wealth can fund lobbying, and that lobbying then can constrain future legislation and the operating space. This example was brought up yesterday about the crypto industry's efforts to build a bipartisan consensus for its legitimization. All of that to say that there are many challenges around consensus, legibility, and timing. They all have implications to policy, and the complexity in all of these dimensions just show the intricacies of what it even means to build alignment and understanding of our choices and how to move forward. So really the paper comes at a really critical moment, and I really appreciated reading it. Thank you.
Thank you, Larissa. We're going to continue with the comments from Jay, and then you, Professor Ulrich, you can answer or comment on those. So Jay, your turn.
Well, thank you very much, Professor Bindseil, and thank you, Larissa. Also, I think really excellent comments, and I agree with a lot of what you said. And I think it's a really important moment to think about the concept of monetary sovereignty, simply because it's now becoming so clearly a thing in the public discourse. And I appreciate Professor Bindseil's outset of saying monetary sovereignty was never a given. It's always been a matter of shade or degree, as you also mentioned, Larissa, and it's really a question of positionality. If we want to use the money view frame, which I'll be using in my comments, it's about where you position yourself in the monetary hierarchy, which is global in nature if we are accepting the global system as it exists and not how we wish it might be. We're not in a flat system where every country is equal. We're all, and I think the paper Professor Bindseil has also highlighted, for example, it's not you're not giving up monetary sovereignty by entering a monetary union, for example. I think that's also a very important distinction to bring that out. I also appreciate I think this is analogous to the money view. I'm trying to build connections here between how we view it as a money view and where the starting point of the interrogation is. I think we're departing from these purely top-down legal definitions and we look at more what is practical and where lived experiences lives. And I think that's pretty much where also, if you want to take an analogy from the MOOC, from the course, we're not debating over definitions about what the ultimate means of settlement is. What is money? Is it gold, or is it the king's money? Those endless debates that never can be won. I think that the real debate is where is all the action, and that is further down in the hierarchy. That's in adoption, and that's where Larissa, you spelled this out so well in all these different places where there is a lot of action, and only in a crisis is the hierarchy actually revealed, right? We don't actually know how the system will break, where it will break, and where shifts into different places will go. And that goes exactly to the core of the definition that you were going to, Professor Bindseil, which is popular sovereignty. I really love that definition because it really is about behavioral elements and about preferences that have to be defined in a community setting. And I think that's also where we have to focus the definition of monetary sovereignty. Where are the communities? We tend in economics and in legal definitions everywhere to simply draw it at national boundaries. And that is a big falsification from lived experience. We cannot define our world ever, and in this way. This is a fallacy to define it in this way. So the question then is, how do we attempt of doing this? And I think this is a very complex exercise because we have so many different dimensions to figure out the sovereignty question, whether it's actually something we should or shouldn't have. And I think it's really coming up in the digital euro conversation where I believe it is a very good idea to sort of have a public option, but the question is, who's it competing with? It was designed against MasterCard, Visa, those non-EU actors, but now it's the ones who are blocking adoption are, of course, the domestic actors, the European actors, the banks that are seeing this as competition. So is that where it's going to break, or is it breaking somewhere else? Very likely it will not break in these ways. So I believe spelling out the capacity question and do we have the ability in money view terms at various places as citizens, as states, as various entities, do we have the relational power to force cash flows in our direction? Do we have the trust? And that has to be analyzed. I think this is can we force cash flows in our direction if necessary? Can we, as Larissa was saying, monetary sovereignty is not simply can we force everybody to use our money when it's necessary. That would go against the popular notion. We look at Argentina, we look at other places. It simply will break a system. It will erode, like 2001, I think, eroded monetary sovereignty by insisting that we have to convert every dollar claim into pesos, for example. So it's a highly, highly complex question. And I think we would do well not to overdefine it in ways that lock it down to very clearly definable things. And it has to become this popular relational where we have options. We have various ways of creating options and partnerships that bring people to the table. People, by people I mean now popular in various ways, institutions. And that's actually, I think, if we want to be very positive about the system, and I think Perry is, in his reading of the various crises, we've had a very good public approach let's say, in the global dollar system. The Fed has taken a role way beyond its domestic mandate in these last decades of crises. And it has come with a partnership by the other central banks at the center to allow that partnership to flourish. And I think now we are forced, if this work into some monetary sovereignty break, is if this partnership is broken somewhere else. So anyway, I have a million other comments, but I think we leave it there for now. I really appreciate the attempt, and I hope we can continue the conversation now with the audience. So I'll give it back to Marina to continue. Thank you.
Thank you, Jay. Professor Bindseil, it's your turn to comment and to answer the questions, and then we will open the floor for the audience. I've seen some questions there and comments, so we will continue with those.
Yeah, no, thanks so much, Larissa and Jay. Very good comments. I mean, what should I say? I mean, Larissa, what you say on goals, I mean, the sharpening that one should, focus on the goals and that the capacity is very important. I totally agree. I mean, now maybe we take it to, we present all those dimensions and we need to streamline this. It's clear. And I really like, the way you explained why we should focus on capacity. And yeah, let me take that up. Frankly, I'm waiting for feedback from the publisher, the supposed publisher, and then, we will work through this again. And I like this capacity perspective. And of course, all this is just a framework. If you go for popular sovereignty, you have to ask yourself on every dimension and detail, what is optimal? It doesn't give you the answer. So you mentioned CBDC, and Jay also mentioned CBDC. So what is the optimal CBDC in the interest of the people? I mean, I would say it is to preserve an available form of public money to coexist with private money for various reasons. I mean, you, Larissa, you mentioned this wholesale versus retail CBDC. I think that's, of course, a debate created, I would say, artificially by the industry, because the two things have nothing together. I mean, they were mixed up poorly also by central banks, all the BIS work, if I may say that, on talking about wholesale and retail CBDC in one go, although one must be about DLT technology, because wholesale CBDC in the sense of electronic central bank money positions we already have, while retail CBDC is not about blockchain or DLT. It's just about electronic cash, if you want. So it was a very confusing discussion. So I think but okay, it doesn't take away the necessity to go into detail and to argue on everything what we as economists believe to be in the interest of the people. Unfortunately, that is there's a lot of detail and controversy in the field of money. What is optimal? That's clear. And then, yeah, you insist on the importance of convenience. Absolutely. In retail payments, it's about convenience at the end. And then you made a very good point that there's a lot of noise on, let's say, blockchain, and very little noise on other projects, which are then at the end very successful. And I think you have this strange logic in retail payments or in payment topics that, if an instrument is out of the money, to use a term from option pricing, you have to exaggerate it. No, you have to talk about it, because you have a slight hope that it becomes known and reaches network effects and generates money. But okay, if you are out of the money, you have to shout, over proportionally how great your thing is. In contrast, if you are in the money and you have a great idea, which is flying and is in the course of deployment, you may not want to talk about it, because you don't want, as you said, regulators to come in too quickly, and you don't want competitors to come in. So the public discourse on payments and money is very biased. There's a lot of noise on things which are not relevant, and on the relevant things there may be very little noise, and for the reasons mentioned and that you mentioned also. So indeed, that's very interesting, and Jay, I think your comments were also consistent with that, and I think I agreed with all of them. I mean, you mentioned dollarization as a big issue, and I think it is. The two big topics are seniorage income, of course, and then the availability or not of macroeconomic stabilization through monetary policy. That's what you lose in a dollarized economy, and you also lose the ability to act as lender of last resort. So all the things which modern central banks can do go away, and that's why dollarization is so important. But the democracies are not so able to prevent that because of, I think, the network effects and maybe fiscal dominance in those countries. So at the end, they exist with dollarization for a long time, and it may even get worse. And I don't think that Argentina will now go against US stablecoins after, the close relationship between the Argentinian and the US administration, the two governments. So I think dollarization in Argentina is going to not get less. No, I mean, Milei had this as an explicit program point that he would discontinue the central bank now and discontinue the peso, even though he hasn't done it. So that that is a trend that is there. And let me stop. Thank you.
Thank you. Larissa, do you want to comment, or Jay, or should we open the questions for the audience to reply anything?
I just
go ahead, Jay.
I just have the point that I made in the chat, I think stands. I think with stablecoin, I think we have a new layer of operational risk that we have to consider, which is it's now stacked. We're no longer dealing with balance sheets that are on European banks. It's not at the instrument level; it's at the wallet level. It's a technological level. Digital sovereignty is also a question that's coming up at the same time. And I think stablecoin, is supercharging both issues at the same time. I think it's a very interesting thing to keep in mind when we talk about monetary sovereignty. It will now be linked with digital sovereignty as well. But just as a flag for discussion. Marina, you can open it for the rest of the group.
Okay, so Alex has a question. I don't know if you want to open it to make it public, Alex, and Rubaina as well. Oh, please, Barry, go ahead. You are muted. You are muted.
Okay. You want me to go ahead or Alex?
Yeah, go ahead.
Okay. So this is a very interesting, maybe some of you have seen a talk I gave to Chris Dessan's operation, where I spoke about the myth of sovereignty, so which was pushing back on this notion of KNAP and the notion of and on two fronts. Okay, so but I think actually they're consistent with what Ulrich has said. So maybe I have an issue with the lawyers like Chris Dessan, but not so much with the central bankers like Ulrich. So Ulrich, what you said was what you mean by sovereignty is that the people effectively govern themselves. Okay, so maybe I will suggest to translate that, okay, into what does it mean to effectively govern yourself? It means managing your interface with the global system, or managing your interface with the private system. So in the money view, we talk about two hierarchies. There's the domestic hierarchy, central bank, private money below that, securities below that. And so that's hybridity. That's an interface between public money and private money, which needs to be managed. Okay. We also talk about an international hierarchy, which is it's a dollar system. So the dollar's at the top, and then sort of the global north is below that, and connected with liquidity swaps, and then the emerging markets, and then the developing countries. So those are at each level of that hierarchy, basis of that international hierarchy, because you mentioned the international piece. The challenge of managing your interface with the global system is different at each phase. As Jay mentioned, even at the top of the hierarchy, the Fed is managing its interface with the global system. It's not itself sovereign in the sense that it can do whatever it wants. That is not the case. It has a responsibility, and then farther down. So the stablecoin keeps coming up. It was everywhere yesterday when we were talking about. So where is the stablecoin thing fitting in? In the U.S., it seems like it doesn't have much of a use case, in the global north, because we already have Eurodollars and so forth. But maybe it does have a use case in the global south, but maybe it's not a good use case. So I think that's what maybe you want to put on the table here, that if this is just dollarization, it's a way for the, Argentinian oligarchs to depart their country, then that's maybe not such a good idea. But we will, so I just want to put that on the table. Like, where does stablecoin fit into the domestic hierarchy and into the international hierarchy? That's the challenge. Your paper is digitalization and multipolarity, right? So I think it's a dollar system. I think we agree about that. So the multipolarity aspect of it is not that we're going to have multiple international currencies. It's the dollar. It's the dollar. And the question is, how do you interface with that dollar system? Which is about par, I guess. It's about the exchange rate, and managing that. So those are just some thoughts. Let me stop there.
Yeah, thanks, Perik. If I can react, the hierarchy thinking, which is close to your heart, is of course correct. It's a hierarchy. It's a system. It's an architecture of ledgers and currencies and interoperability. And of course, every currency is a separate ledger, which then has domestically sub-ledgers in the form of banks and payment systems. And it all interacts in some way in ideally a smooth and stable manner. And internationally, those are all separate systems, and they are interlinked with, at the end, correspondent banks. And the readiness either of the central bank or of the private sector to engage in cross-border net positions, to compensate the capital flow initiated by others. And there are some markets which are efficient, and the US is the efficient market, but the US has some issues. And one issue is the use of sanctions, of course, against foreign positions. All the system relies on having accounts and securities and so on in the US, liquid reserves. So if you feel that in the times of geopolitical deterioration and sanctioning that can be taken away from you, you have strange things are happening now, like the run into gold. The central banks who start thinking, I don't want this huge net foreign position, and therefore I start to buy gold and import it and reduce my position. So lots of things are happening there that are very relevant and that will continue for a while. And that's interesting for predicting the gold price, of course, also. And then maybe last point on stablecoins, as you say, the use cases are not so obvious, or at least the good use cases are not so obvious. I think the Argentinians, it's not only oligarchs, but in Argentina, I understand you have to pay real estate transactions you pay with dollar cash. So yeah, apparently stablecoins are also accepted now for that. So cash is just, a bit risky. You have to deposit it with the bank. There can be a bank robbery, it can disappear even there. If you keep it at home, it can be robbed. So maybe it facilitates dollarization from a certain perspective, but that's not such a great objective use case. And all the other use cases are to be seen, are still to be demonstrated, I would also say. Thanks.
Thank you. We have time for 2 more questions. So, Rubania, you wanted to ask a question time ago. So if you want to ask it,
Thank you.
so thank you.
I just
And Asger is the next one.
Thank you. I just wanted to maybe read this out, but I think Jay sort of addressed that issue of the added layer of digital sovereignty, because all of this we're talking about is happening through these other the operational measures. So specifically with the central bank digital currency, I was wondering if it would actually allow monetary sovereignty if ECB does move towards using US-based cloud services, and then the data is going to be with them, and then we're theoretically try to come up with this sort of technical differences, but in operation they might undermine sovereignty just because of the nature of cloud services right now. Thank you.
Yeah, that's a constant issue to also ensure that everything you use is then sovereign. And the cloud services. I mean, I know that digital euro at least will not rely on the cloud. The database will not be in the cloud, even if, it's more costly, of course, to have it locally on servers. But another example is that, of course, digital euro payments will be mobile payments on mobile phones produced not in Europe for sure. So there's a kill switch somewhere in any case. So it's a very relevant point you raise, yeah.
Thank you. And then Asger, your turn.
Yeah, thank you so much for this very good overview, Ulrich. I following on the discussion last point of Perry and also maybe linking to Rubiana, and your last 10th point, if people decide, I mean, assuming that the Genius Act, the Stablecoins roll out, the Supervision Act, Clarity or whatever it's called, somehow gets through, and actually people in countries like high inflation countries, I mean, we have only 5.2 here, but Argentina or some other case, if people have the technology and start to adopt it, like as a community more, like, and it will be widely used, I started to think about it could become like a additional tool or a weapon. I'm thinking Nicholas Mulder, the sanctions, and I'm thinking about what happened in Iran a few weeks ago when the protest started. It was admitted in a hearing in a parliamentary hearing of Hexet, I think. They turned down the dollar access of the biggest bank in Iran. They went bankrupt. People couldn't buy food. People went out on the street, protested. And like, yeah, so turning it to some other southern part of the Western Hemisphere, you will have gained control over countries through the payment system when people have started to use dollar as a means of payment through some kind of public stablecoins, and then you can use it, when you are doing something bad or strange. Yeah, so it's a problematic of if a community decides to use something that's provided globally, and then the commander-in-chief of the global system is not thinking about the best of the public, but more of his country. I mean, I'm thinking, Kindleberger, for the stability, we need the stabilizer. And if the stabilizer is unstable, yeah, where are we heading? Sorry, my question is kind of flavored by the news of the day, but your reaction on it would be very interesting still, I think. Thank you.
No, thank you, Askia. Your question is, I mean, it's not a question, it's a statement, and I can agree with it. That's why we talk about strategic autonomy. And it's not only in the field of money, of course, it's in the field of weapons and in the field of cloud and everywhere. And Europe has a long list of issues here. And I hope there are good policies to get it better over time and not worse, because I think currently, if you extrapolate the trend, it's not yet getting better. No, we are talking about it, but we have much more to do to reverse the trend. Yeah. Thanks.
Thank you. We still have some minutes left. David, do you want to ask your question? Or do you want me to read it? David Brown. I can read it. So he's asking, has a conservative BCDC with a small cap overlapping uses cases with e-money tokens?
A CBDC, I mean, CBDC, if you go back to the 2015 papers, the very first one using the term CBDC, the authors there meant really something tokenized, no? Then this meaning disappeared. And if you look at the digital euro, it's not, it has nothing to do with tokenization. It's not central bank money on blockchain. It's a conventional central ledger based payment instrument, not so different from Visa and MasterCard, but in using central bank money to some extent. So there's no central bank, or none at least I'm aware of, that is currently really working on tokenizing central bank money. So to put it on a public blockchain and to be transparent, I'm trying to write a paper on this topic to return to this idea, because you could say if we are all so excited about stable coins, then why are we not excited about putting central bank money on blockchain? And then at least, designing it to the extent you can, and choosing the blockchain and, building into, let's say, abilities to block funds if they're used or believed to be used for illicit purposes. So we can pursue all the policy objectives, and can reap the assumed big benefits of public blockchains, no? And if I would be, I don't know, any country in Africa or in Latin America, and I'm worried on stable coins, and I believe that this is partially because public blockchain is a nice technology, then I would go for putting my central bank money on chain. And I think this topic could come back a bit, no? It had somehow completely disappeared, and all the focus of CBDC was then on conventional POI solutions.
Thank you very much. We're gonna stop. There is another question that I'm seeing, but I think we are we have like 4 minutes. So I don't know if you want to answer what problem we solve with the CBDC or stable coins, which you are touching a little bit, but if you want to.
Yeah, with CBDC, I mean, we just preserve the role of central bank money we were used to, and central banks exist because network effects of money are overwhelming, and therefore you if you leave it to the private sector, you have one dominant player who will abuse market power extensively. So that's the logic why we had central banks emerging and being, there was a phase in the 18th, 19th century where central banks were private, in principle, had private shareholders, but they were subject to a law which, told them, gave them the policy objective and the control functions of the government. But then in the 20th century, they were almost all nationalized, and that's where we are today. And if if we stick with 17th century technology only, and people love convenience, as Larissa was saying, then yeah, it will disappear. And there are network effects also in the use of cash. If all the shops, just are fed up, getting from time to time a bit of cash, they will say, I don't want cash any longer. And then it swaps fully to electronic. And then, yeah, we all use MasterCard or Visa card or EPI. I mean, one must admit that the Brazilian and Indian solutions based on commercial bank money, but on a powerful, government or central bank setting, the rules of the instrument. So in Brazil and in India, there's no merchant fee, if I understand correctly. So it's not popular with banks. It's in commercial bank money. It avoids, the excitement of introducing electronic central bank money, but it's not popular. Banks hate it because they don't get, a part of the merchant fee. So it's really in the interest of the public, the merchants and the consumers. And I think you can reach quite a high percentage of the policy objectives of CBDC because you control, that there's no abuse of market power and that public policy objectives are respected in a commercial bank money-based solution. So maybe with that you can reach 70% of the policy objectives of CBDC with very little drama, no? Of course, the Brazilian banks, I understood, they sleepwalked into this. They didn't pay attention in time. They didn't, activate their lobby efforts in time against PIGS because it took away, attractive seigniorage income. Not seigniorage, sorry, fee income from card systems. So there's apparently a surprise. Even in Brazil, there was a surprise that the banks didn't get that right in time. But it's in the interest of the people for sure.
Okay, thank you very much. Thank you very much all for actively participating in this so important, very timing subject that is not
Thanks.
only raising current themes, but also questions that were asked in the 1800s as well. So it's very interesting as well. Thank you, everyone. We will have 5 minutes of break, and then we will come back with the next session.